Look, when the yield curve moved around, the punditocracy got going, saying, here, this means a recession is coming. But if you actually think about it, there could be two reasons the yield curve is moving around. You're seeing that debate take hold, which is part is the debate of a flight to quality. That this is 80, 90% of all the yield in the world is available in the United States. So the money comes flying here because you're going to give your money to someone $1,000 and they give you back less in 10 years, or you're going to give your money to someone $1,000 and they give you back more in 10 years. And so that's why there's a great debate about that. But what's going to come down to is what's really going on in the economy. And when we see the economy at Bank of America, we have lots of different ways we think about it. Our team in Bank of America Research, who predicts the U.S. to grow at 2.3% GDP this year, high ones next year, maybe 1.9. And they've moved that up and moved that down and basically settled in at that point. If you look at the broader economics, a consensus blue chip, there's not one person with a negative number for 19 or 20. And so they're saying it's growing. But what's going to make that happen is the underlying U.S. consumer. And the underlying consumer is doing well and making more money, they're employed, and more importantly, they're spending more money. And so in our customer base through this time, August 15th, year to date, you've seen the amount spent by American consumers at Bank of America, $2 trillion. It's up 5.9% from last year through the same period of time. So in 17 to 18, you're up about 8.5%. 18 to 19, you're up about 5.9%. So think about that as $120 billion more spending by our consumers this year versus last year, which means the U.S. consumer continues to spend, and that will keep the U.S. economy in good shape. You talk about the punditry and people who are out there. There was a Bank of America economist last week who raised her own odds of a recession. She said she was going from 20% to 1 in 3, so 33%, based not on a change in her model, but kind of a subjective call of what she's hearing, what she's feeling, and what's happening out there. Would you disagree with that? Do you think odds went up last week yourself? I don't think odds went up last week. I think the odds of a recession debate have always tend to run 20%. Like if you actually look at the most recent survey, there are people who have this year predicted still in the 10% level, which is only 2 quarters in a row have to be negative, and there's only 2 quarters to go, and we're halfway through one. So I think that when Savita and the team changed, Michelle and the team changed, they're looking at it. But what they put the overlay on, frankly, was what everybody's thinking about. So if you think about the business economy on the world and business economy U.S., there hasn't been a lot of good news. And that not good news is largely around trade, European slowdown, what's going to happen with Brexit, China's slowdown. So those issues that still need to be resolved out there are affecting business enthusiasm and business energy. And so you're seeing capital spending come down. And I think that's the overlay that they put on, was really around this question if trade doesn't get resolved. Now, the reality is, in the few months that the trade issue since May or so when it really kicked up, we're getting used to it. And most of the people believe that the China situation, which is very difficult, is going to take a lot longer than people think to resolve fully. It may not get worse, it may get better. There may be debates about what's going on, and you hear it every day. But the reality is it may take a long time, and that's where I believe that the keys were to get the federal budget situation fixed, which is for 2.5 years. We've got to get the USMCA passed, I believe, because that settles the biggest trading block that we deal with down and that we have an agreement. And ultimately, we've got to get through Brexit and figure out what happens there. And we got to also figure out if China can sort of restart their economy, which they're working on, but it's difficult when they have the pressure of the trade.
If you're seeing such strength in the economy, and particularly in the U.S. consumer, what do you think when you hear President Trump saying things like, oh, we're considering a payroll tax cut, we want the Fed to cut 100 basis points? I mean, I look at that and think those are extreme measures, things I would have expected in 2008, 2009. Are they warranted today?
Well, I think if you think about whether it's what Jay Powell's talked about and the Fed minutes we'll talk about, we'll see what they say today, but generally what they're trying to do and what the president's trying to do and what the world needs us to do, it's one sort of singular thought, which is the U.S. economy, which is the largest in the world by a lot. The U.S. consumer economy is as big as China's economy. So just think about the U.S. spends on healthcare the entire size of the Indian economy. So think about the dimensional difference. The one thing the world can't afford right now is for U.S. not to continue its growth cycle. And we are the longest growth cycle we've had. And everybody then starts to raise, well, it can't keep going on forever, and that's probably true. And so you have this debate of how do we preserve it? How do we make financial conditions more accommodative? How do we create extra, like we did in 18 with the tax reform and some of the regulatory reform? How do we create extra stimulus? And that's the debate going on. But the goal is, even though people can, as you said, the punditry or the punditocracy can keep separating these positions, it's a common position to drive the economy forward. what we see from the U.S. consumer and unemployment and housing being solid and all those things, we don't see the measures that need to be taken. But there is a diligence around this because it is a big economy. And if it goes backwards, it'd be exactly the wrong time for the U.S. to have a problem.
So you'd be okay with those types of measures that we just talked about? If the Fed cut 100 basis points, that's good news. If we did see a payroll tax cut, which, by the way, would add to the deficit, maybe $150 billion to a deficit that's already over $1 trillion.
I think the Fed's going to be driven by the data. I think they've been clear about that. We'll see what is said through Jackson Hole. I mean, 8 years ago when they went out there, this is when when Bernanke said lower for longer, and that's really sent the markets in a bit of a interesting time in August and September of 11, if you remember. It was kind of interesting out there with everything going on. But
which is why you see so many people here at their desks today.
Exactly. Right. So there'll be a lot of discussions, but I think the question really is how do you keep the conditions favorable to things? Rates are low, and whether the extreme level that you're talking about or not is needed or not, that's going to be a subject of, I think, literally the data at the given time. Right now, the unemployment, right now wages are growing, right now inflation's nearer 2% than it has been, and right now you're seeing that unemployment levels are very low and new claims are low. So you kind of have this question that the data hasn't deteriorated, and you're hearing people talk about this, and that's going to be on the table. So whether you call those extreme measures or not, I would say that everybody will do what's needed. I don't think the current data shows that something's needed, but it may over time.